Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:19 a.m. Central Time, and I'm recording this in preparation for market day, July the 2nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, from the morning reading, and I've got quite a bit of headlines and so forth that I'd like to share with you from the morning reading today. First of all, stocks bounce on hope of Greek compromise. Longer range indicators show negative divergences and suggest deterioration beneath the surface. Dow weekly and monthly MACD lines are negative. Less than half of the New York Stock Exchange stocks are in uptrends. Dow and S&P 500 try to find support at the 200-day moving average line. Greece makes day-to-day market analysis a lot more difficult. Obviously, one minute you got up, and the next minute you got down, and you're kind of wondering, what does it really mean to the long-term health of the market? Is Greece simply the excuse behind what's really going on with the market? And that's something we're going to explore here with some of this reading in the next few minutes. There's been a number of negative stock divergences that have existed in the U.S. stock market for several months and set the stage for possible sell-off. Continued negative divergence between the Dow Industrials and downtrends in the Dow Transports and Utilities, and how weakness in the latter two groups were pulling the Dow Jones Composite Average lower. Large negative divergence between the Dow Industrials and the 14-week RSI line. What's troubling is the big negative divergence between the Dow and its 14-week RSI line. That divergence is especially noteworthy this year. While the Dow hit a record high during May, the RSI line has dropped into negative territory. In a healthy uptrend, the line should be rising. A falling RSI line usually signals loss of upside momentum. Weekly MACD lines are also falling. Negative divergence between them has become more pronounced during the first half of this year. The weekly MACD lines are not only negative, but the two lines are diverging. Monthly MACD lines also turn negative. Signals on weekly indicators are a lot more meaningful than signals on daily charts. By the same token, monthly signals are much more serious than weekly signals. Itself is a caution signal, because it implies that the market's major uptrend may be stalling. Even more troubling is that the negative spread between the two lines is now at the widest since 2009, when the market was turning up. In fact, the monthly MACD lines have been in negative territory for the last 5 months. That doesn't predict a major downturn line like we saw in 2008, but it does suggest that the stock market may be at its most vulnerable position in several years. Let me say that again. The stock market may be at the most vulnerable position in several years. That's often when accidents like Greece can cause bigger problems. Less than half the New York Stock Exchange stocks are in uptrends. The percent of New York Stock Exchange stocks that are above the 200-day moving average, only 2/3 of the big board stocks were in uptrends when the New York Stock Exchange hit a new record. Since then, the red line has fallen 44%. That means that more than half the New York Stock Exchanges are below the 200-day averages. Meanwhile, the New York Stock Exchange Composite Index is within 4% of its spring high. How can you call it a bull market, and how can a bull market persist when the New York Stock Exchange has more than half of its stocks in downtrends? And then longer-term indicators demonstrate that the stock market is suffering deterioration beneath the surface. In the past, these negative divergences have usually led to market corrections. A Greek resolution would probably give a boost to stocks over the short run. The weekly and monthly charts shown, though, suggest that stocks may have a bigger problem to deal with. And then finally, the last from the morning reading, short-term seasonality turns suspect for stocks after Thursday. The day before the Independence Day holiday has been a moderately positive bias for the past 20 years, but the week following has not. The spider was positive 45% of the time, but higher beta indexes and sectors were less consistent. IWM small caps was positive 40% of the time, XLF financials 31% of the time, XLY consumer discretionary 31%, and XHB housing 22% of the time. So obviously seasonality is always something to keep in mind, especially when you have high percentages, or in this case some very low percentages, because it kind of gives you something as a predictive factor, but certainly that doesn't mean that it happens this year. So it's always something that you have to kind of keep in mind, and then you look for in the charts, in the price action, actual indications that that seems to be following through. Pretty interesting with the seasonality. So wherever Greece goes, and obviously we're not likely to get a resolution on that before our holiday. Sounds like it's going to easily spill into the weekend, and could make for pretty significant change in the market situation before the Monday open. So something to kind of keep in mind there as well. Let's go ahead and drop into our regular morning reports. Let's see, first of all, let's go to the morning report. In terms of overnight action in the U.S. broad market indices, it's really essentially scratched. I mean, they're slightly positive at the time of this cut, but nothing significant enough to really say anything. And of course, we're going into the monthly unemployment report, which has moved up a day because of the holiday, and that could totally trounce whatever is showing here. In terms of crude oil, up 0.5%. Euro up about 0.25%, bonds down about 0.33%, and gold down about 0.2%. Big mover in the overnight was China, down about 3.5%. Hong Kong was essentially scratch. Japan up about 1%. Germany essentially scratch. United Kingdom just marginally up. In terms of macroeconomic reports for today, the big one, of course, unemployment. And that's really the story today, and you can see the other countries if you have special trading interest there. In terms of current volatility, you see the short-term VIX has been dropping. It's now below 20 at a 17.23. See the put-call ratio 0.62. IV percentiles 37, 37, 39, 56, so significant falling from where they were, which was running around the 50s, and for the Dow up around 75, a couple trading days ago when we had these big multi-standard deviation moves. Since that day, we've had back-to-back days with less than a standard deviation move, and indeed, when we take a quick look at the chart here, you see with the S&P, we had the big 3 standard deviation moves, something of the dead cat bounce, and then there's, you have to say there's some bullish continuation here. You wondered if you're going to get a dead cat bounce and then roll back over. That did not happen. We did get bullish action yesterday. It's hard to make too much of anything right now, though, until we get some resolution shown in the markets, and whether that resolution is from Greece, that may be the accident, that may be what the talking heads talk about as what is moving things and so forth, but oftentimes when you look and you see the actual timing of moves in the intraday and so forth, it obviously there's a number of other things going on, and it's not just about Greece. This is kind of interesting. You notice how the top of the day, and this line's been here for a while, it turned right at what was the former diagonal support. So another situation where support turns into resistance, and that stopped the up action of the day. Now, it's not, diagonal support lines aren't as significant as horizontal support lines, and obviously there's something to be said for, is that even where it should be drawn? Obviously it meets these points here really nicely, but we had undercuts here and here, but that also lined up with where I had the horizontal support, and obviously yesterday's action plowed straight through that. So bottom line is, much like the few days before the Memorial Day holiday, where we had the breakout above the range, but then failure as soon as everybody came back after the holiday, and then we had this 3 standard deviation move that took us below the range, but then 2 days later, here we are closed back inside the range. So are we just simply back where we came from? And we're back in this trading range between about 21.30 area and perhaps about 2070, and that's just back to the trading range and more of the same, and perhaps even could persist for some weeks to months forward, much like it has in the past. And these were just aberrations to that activity, or is this going to be a bear flag and something more to the downside? Not really sure about that yet, but we'll continue to watch things like from the morning reading to see what our indications might be. And certainly you take that information from the morning reading along with what we have here in our own daily report and our assessment of risk, and it would seem that it is not a time to be initiating a lot of new bullish positions. And remember, this is a risk assessment. It is not a prediction that we're going to have a correction. There's two very separate different things. But certainly when you identify elevated levels of risk in the market, it should shape your behaviors in terms of initiation of positions, risk management, money management, position management, all these kinds of elements of your trading. And certainly right now we're showing a significant consensus from a whole bunch of different systems that I have brought together here, and how I developed this market opinion about the risk assessment, that there is significant reason for concern. Indeed, the market trend intermediate term phase opinion is now a phase 5, which is that break of diagonal and horizontal support. Technically we did close back within the range yesterday. I'm not going to come back off of phase 5 and call this back to higher highs and higher lows until I see something that is more settled. But we've had the most recent action here is a break of diagonal and horizontal support, and we've got a significant lower low, and indeed you have a swing low, a lower high, and a lower low. If anything, in the most intermediate term posture, this is a intermediate bearish trend, and until we start to see some higher highs and higher lows, we'll probably stick with this phase 5 opinion. In terms of IBD status, we have an uptrend under pressure. Accumulation distribution is rated a D+, and NASDAQ also D+, so obviously not great there. GMI index, a 1 out of 6, and issued a sell signal on June the 30th. And then our market posture, very bearish. And indeed, the market posture scores 26.4. If it goes below a 20, it becomes severely bearish. The Dow at 19.4 is severely bearish. NASDAQ, 34.3, very bearish, and Russell, very bearish. So nothing here to point to any kind of healthy market whatsoever. Our overall hedge risk level is a level 2, which we call the red lights. From the various components there, volatility, you do have a market and decline warning, though the short-term to intermediate-term status did ebb off. That no longer is a warning status. In terms of the VIX spike, you did have a VIX spike a couple days ago, and then that actually signaled with the drop in the VIX a long market signal. So that actually is a sign for the bulls to kind of keep in mind. And actually this says yes, the The VIX is below an 18 now, so that should be no. So that also has resolved. That VIX squeeze did fire long, and that certainly fires for increased volatility. So we'll see if that subsides. So we seem to see the VIX falling back, and much as you would expect after a spike. We'll see where that goes in the next couple days. The number of distribution days for the S&P sits at 7 and the NASDAQ at 5. This has continued in recent weeks to be very high. Volatility ratio warning is still yes. VIX phase has been climbing. Skew just below 125, which is the cautionary level. Look at the new lows. Yesterday, 531. We had very high count the day before as well. And then also very importantly on our risk aversion indicators, all 5 of them are still flagged as risk off. In terms of special opinions, we did have, with the VIX dropping, VIX back inside the acceptable window, which means that conditions are acceptable for new positions. Given all the rest of this on this risk assessment, I would say that position sizing should be very much considered, and then also consider the potential for increasing volatility. Now we're kind of mid-range right now. Obviously we could actually drop in volatility or we could increase. Given the context of everything else that's going on, that we would actually increase in volatility is probably the more dangerous thing that could happen to your position. In terms of covered call strategies, novice traders should probably not initiate any new positions. Aggressive traders should probably think about a 1-to-1 distribution between in the money and out of the money strikes. I was talking with another trader just yesterday and mentioned that every one of my covered calls has worked and has been fine throughout this ranging market, but it has been because of the in-the-money strikes that they have been largely successful, not the normal buy a covered call and buy stock and sell a covered call out of the money and look for bullish action in the stock. What has made me money in this strategy in recent weeks has been this equal distribution between in the money and out of the money strikes, and most of that premium coming from that in the money strike. And with the stocks largely, and these are really high quality, very carefully screened stocks, the best of the best, and yet very little follow through on the upside in a number of cases, and the premium from that in the money strike being the source of the profit. So obviously in a rangy market we take profits wherever we can get it, and this is a great strategy for a market environment such as this, but you also have to be postured in such a way that you recognize the lack of follow-through that we currently have. And along the same ways, put selling conditions are really not that acceptable for new core put portfolio positions. Aggressive traders should consider put credit spreads with defined risk and consider scaling into positions until the market has confirmed a more bullish posture, and clearly we're a ways away from that. Not a bear market, mind you. Now understand that. We're not calling this a bear market yet, but we're certainly about as close to getting to where you would call this a rollover into bear market conditions as you can get without actually being there. In terms of sector market posture, obviously I wouldn't call this a Christmas tree. There's not much green there, but certainly not a lot to point to for the bulls. Consumer discretionary, and in fact I was looking at some benchmarks for year-to-date performance, and consumer discretionary and healthcare were the only two sectors that had really done anything in the year-to-date performance, and it's not surprising that they're perhaps the two sectors that on this sector-specific market posture look the best even on this trading day. Percent change, mostly green yesterday with the exception of energy. Obviously crude oil took a hit yesterday, but still very, very poor consistency. 1 day, 5 day, 1 month, 3 month. You're not seeing much in the way of consistency of performance. Perhaps that consumer discretionary and that healthcare being, as we mentioned earlier, and you see the year-to-date 7.1, 9.6, whereas look at everything else. They're either red or they're just basically scratch. So really only those two sectors have held up. But if the market does roll over into something more significant, into a full-blown correction, or perhaps ultimately into something that's bigger than a correction, it won't matter that you hold healthcare and consumer discretionary. They'll still be negative. So kind of keep that in mind. Probably enough for today. We had a big report today, a lot of information to share, and at 20 minutes it's certainly at threshold of where I like to be. So let's wrap this up. Obviously, if you find this information helpful, we greatly appreciate you liking us on YouTube, retweeting us to your Twitter followers or to your stock twits, etc. More information can be found at this website. Performance matters, we get it. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll look forward to seeing you back here on Monday morning before the market opens after the holiday. Have a great Independence Day holiday.